Hello and welcome everyone to our fixed income outlook for 2025. First of all, wish you all a Merry Christmas and a very Happy New Year. As we look forward to welcome 2025, fixed income market sentiments have been somewhat depressed because of the sharp rise in the US 10-year yield in the past days. After the last FOMC meeting, where the Fed cut the key rate by 25 basis points, they indicated at the same time that they might be a little cautious in future in terms of the further rate cuts. Because of the recent slight spike in the inflation in US and because of the continued strong momentum in US GDP, the need for immediate further rate cut may be somewhat diluted. Further, the recent victory of Mr. Trump and the so-called Trump trade by the markets, the outlook is somewhat clouded because of the possible tariff hikes and other changes in the trade terms with the other countries. Further, a large government spending may lead to higher inflation and fiscal deficit. These are the worries that have been clouding the market. However, there is another aspect of the Trump trade which is to stabilize the geopolitical situations by bringing down the escalation levels in the ongoing conflicts between Russia, Ukraine and Israel, Lebanon. So, our perspective on this situation is that the improved geopolitical stability and further the focus on government expenditure saving by a target of 2 trillion under the new Department of Government Efficiency will offset more than the impact of the trade related measures and so on. Thus, we believe that the Fed will continue to cut rates. In the last FOMC meeting and the one before, Fed has continued to indicate its terminal rate to be at about 3% and that they are just going to be slow, but they are still going to be cutting rates. As per the last dot plot by the FOMC, the Fed rate will be cut by about 50 basis points in 2025 and then by another 50 basis points in 2026. So all said, I think the global outlook for the fixed income markets is still supportive. However, these kind of intermittent disruptions will continue to bother us. Even in 2024, we saw a couple of phases where the markets became very negative and uncertain. However, we believe that all of this will resolve on the positive side and therefore we are constructive on the global fixed income outlook for 2025. Insofar as India is concerned, RBI has already changed its stance to neutral in the previous policy, and subsequent to that the headline inflation has fallen from about 6.5% to 5.5% in December. More importantly, the GDP growth for Q2 FY 2025 was reported at a very disappointing 5.4% versus the market expectation of somewhere close to 7%. In its December policy, RBI revised the GDP growth forecast from 7.2 to 6.6% for FY 2025. That's a very significant drop. At the same time, RBI also revised upwards its inflation projections by a small margin. However, the inflation is largely due to the highly volatile food and vegetable component, and within that, for example, in the month of December, the drop in the inflation is largely or at maximum contribution by the drop in the tomato prices. So, our view is that if the RBI has to shift focus towards growth, then they will have to be a little more tolerant towards inflation, especially if it is driven by the highly volatile food prices. As a result of the evolving macro situation, it is expected that the RBI may not be able to cut rates immediately because of the slowdown of the rate cut pace by the Fed and because of the high headline inflation in India. However, the RBI will continue to get more and more supportive of a softer interest rate regime, especially for growth. If the economy is now on the so-called treadmill where the RBI will have to run faster and faster just to be able to maintain the current momentum of growth, and therefore the outlook for 2025 is rather constructive on the fixed income side. We need to remember that in 2024 there was no rate cut and there was no other action, but the bond funds for 2024 gave a double-digit return after a long gap. In 2025, with the overall macro environment more supportive, the fixed income products should be equally constructive. Within the fixed income space, the low duration category, the short duration category and the long bond category are the ones which are expected to be a little more constructively placed as compared to other categories because of the specific situation. So with that, I think it is time to still remain invested, and every correction in the market in our view is an opportunity to further add to your investment with a long term perspective and with the patience to navigate through a volatile phase. We believe that fixed income markets are still worth looking at constructively. Thank you everyone and happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.